Hello and welcome to Portfolio Matters Share Talk. In today's Share Talk, we will be going further afield and we will be discussing the Canadian listed copper miner Excelsior Mining. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So, tell us all about Excelsior Mining, Keith.
Okay, Excelsior Mining is a Toronto-listed copper mining with an in-situ acid leaching project in Arizona and teething problems. So Excelsior Mining is listed on the Toronto Stock Exchange. It has a share price of around 86 Canadian cents, a market cap of 232 Canadian dollars, which is about 136 million sterling. And it has cash of around 13.6 million Canadian dollars. Now, it is getting its first revenue. There was some revenue last year, but it really gets going this year. Essentially, the production was due to start last year, but was delayed by COVID. And in the fourth quarter of 2020, they had their first copper sales. Okay, in summary, this is a company with an in-situ acid leaching mine in Arizona, and it's just at the start of production, but they have had teething problems. And we will go through all the problems that they've been encountering, and there is a great YouTube video interview with the CEO where he goes through all these problems, and I would urge everyone viewing this to go and watch that video because it's very informative. And if we calculate the valuation, these shares look cheap. However, in order to realize the value, the potential value, they will need substantial capital investment to increase production from the current 25 million pounds a year to their target stage phase 3 of 125 million pounds a year, which is 5 times larger. And how are they going to fund that? And will that be dilutative to shareholders? So why are we looking at Excelsior? Well, when I was researching Phoenix Copper, which is a London listed mining company, I came across a table which compared the economics of 19 different North American copper mining development projects. And these are the top 5 sorted by internal rate of return. And you can see number 2 is Excelsior Mining, the Gunnison project. Number 1 has very low grades and is something we may look at in future, but you'll see it has very high capital intensity a ton, whereas Excelsior is very low. And actually, when you look at capital intensity per ton of copper, Excelsior is the best project. So it's the one that will require the least amount of capital to get off the ground. And it also has the second highest internal rate of return. So I was intrigued. I will post that spreadsheet showing the 19 different copper projects in North America to our Discord for anyone who is interested. And separately, we will also look at some of the others in that table later. Okay. Before we get into it, what is in situ acid leaching? Well, we have covered this in part when we did our ferroalloy resources share talk, but we'll go through it again. Now, Normally, mining is either you dig a big open pit like centamin, or you dig deep into the earth, also like the deeper part of the centamin mine, or, and here's what they do, the Excelsior are doing, you don't do any of that. You drill down into the earth and you pump in acid to dissolve the copper, in this case, and then you extract it separately from another well. Now, in situ acid leaching is actually a very well-known method of mining, but it's mainly used in uranium. It's much less used in copper. And so some of the teething problems that Excelsior are experiencing are just due to the fact that this is relatively new, certainly to them, and there is little expertise in the acid recovery of copper. And this is essentially what you do. So the white well is you inject acid down into the mineralized zone. The acid leaches out through the mineralized zone, dissolving the copper, and then you have recovery wells where you extract the pregnant solution and you then recover the copper. Now, the thing is, this can only be done when you have the right geology, because obviously it's if it could be done everywhere, this requires a lot less capital and disruption of the earth than traditional mining methods, and you would think it would be done everywhere, but it can't be done everywhere. It can only be done when the ore body is highly permeable, so the acid you pump in will go through the rock, and where it is below the water table, so the acid can be transported through the ore body, and that is rare. Okay, so this is one of the advantages of in situ acid leaching. When the whole project's done, you can just remove the wellheads and return the surface back to as it was. You have extracted the copper from deep in the ground, but actually surface disruption should be minimal. And this is a diagram of exactly how they are intending to do it. You have, notice this grid. So the orange wells are injector wells, and the pink wells are extraction wells. Now, that is how they were intending to do it. As we go through this, you'll see that unfortunately things got a bit more complicated. But the advantage is that there's a lot less disruption. You don't need to move as much rock and is much less disrupted to the environment. However, there have been instances where abandoned in situ mining has meant that minerals have leaked into the water table, and so that it is not without problems. Okay, so let's go through the history of Excelsior, and this is quite long and I'll try and push through it. So this is the history, and so this project has been a long time in the making, and one of the reasons I want to go through the history is just to show you how long it takes to permit, design and fund one of these projects. Okay, so let's go right back to the start, 2012. So core samples taken on Gunnison 9 years ago. Resource estimate of 3.2 billion pounds of copper at 0.32%. That's a lot. Raises 1 million Canadian through, sorry, 1 million US through share sale at 16 cents. Pre-feasibility study gives a great NPV of 1.2 billion. Then it's going to fund itself through share sales continually, and through here you're selling a gross royalty revenue to Callinan for 3 million. So it's also giving away royalty streams. And you'll see, to get this funded, it has to give away quite a lot. Share sales, upgrades the resource estimate to 4.95 billion pounds of copper, measured and indicated. It purchases the Johnson Camp mine, which was in receivership, and they're going to use that for the processing. November 2016, it raises a further 14 million at 46 cents, and also sells 1% gross revenue royalty for 4 million. I mean, that is not very much for a 1% gross revenue royalty. Moving on, 2017, more share sales. Successfully completes permitting 2018 and is allowed to process up to 125 million pounds per annum. It then does $75 million financing by selling a copper stream. And we will go through the economics of that, but you have to give away quite a lot. So that copper stream will allow Triple Flag Bermuda to buy 16.5% of the copper output from the mine at 25% of the spot price. So that you're giving away quite a lot there. Then commences mine construction. That is the best part of 3 years ago. Further share sales. In October 2019, completes construction and starts wet commissioning. So starts moving fluids through the mine. Then December 2019, receives approval to commence mining operations, which was terrible timing because we all know what happened in 2020. Just as they start mining operations, COVID hits, but that is not the main cause of their problems. Now, one of the problems I have, and one of the, analyzing this company, and one of the reasons that I always go through the news is that it tells you not only what the problems were, but also how the company has announced those. And the bottom line is, if you go through the quarterlies, you don't really get a picture of the problems they were encountering. All they say on the 8th of February 2020 is that all injection pumps will be retrofitted to allow them to become recovery wells. Doesn't really say why. It doesn't say that that is due to the fact they're encountering problems. But you'll see that somebody knows something. The shares collapse from 1.2 Canadian dollars to a low of 45. When obviously this is simultaneous to the collapse in the copper price because of COVID, and the 26th of March suspends operations due to COVID-19. Then places the Gunnison mine in care and maintenance. 10th of November, limited operations restart. And then in December, it produces its first copper. And in January this year, it sells its first copper to Trafigura, who have the contract to buy all the copper from the mine. Then in February, it raises 32 million and 95 cents, which is above the share price now. Okay, so let's go through a corporate presentation. So is the copper sheets that Gunnison mine will be producing. It's in Arizona, has low operating costs, and they're saying in-situ acid leaching is environmentally friendly. It has institutional backing. So essentially it had to sell a lot of shares to institutions early on to get this funded. And this is an overview of the mine. And you can see here what it looks like and how there is minimal surface disruption. So what you're seeing here, that is a well. And then that pipeline is either a recovery pipeline sucking out the copper-rich solution from the ground, or it is a line which can inject sulfuric acid into the mine. Okay, so you then have the pumps here, and each set of pumps operates a segment of the mine. Now, in order to expand operations, all you have to do is drill more holes, connect them up, add more pumps, and off you go. It's just a question of capital and also making sure you have the production capacity to process the liquids coming out of the expanded operations. And you remember earlier we said they'd bought the Johnson Camp mine, and this is what they'll be using to process the liquids. Okay, now they're in Arizona. There's a lot of good infrastructure around, and it's a stable jurisdiction with predictable taxes, all of which is good. And also they're saying there is a lot of copper here. Now, obviously they won't be able to recover all of it. There will be a percentage left in the ground, but if they recover a decent percentage of it, you know, this is a big project. So when you look, because there's minimal surface disruption and you don't have to move the earth, that means the capital costs for developing the Gunnison mine are relatively low. And so if you look here, this shows the comparative internal rate of return of Gunnison compared to lots of other copper projects in the US and around the world. And you can see the internal rate of return is very high. It's the highest of any project anywhere, they're saying, although obviously their annual production is relatively low compared to some big mines elsewhere. And this is the mine development cycle, value cycle, which regular viewers will be very familiar with, and which we also looked at in our last video on Castillo copper. Now, Excelsior are here. They're right at the start of development. They have just produced their first copper. So what they are trying to say in this chart is that they're just at the start of value creation. And they're also saying that in situ copper production is not new in Arizona, that there are other mines using the same technique. In particular, there is the mine owned by Taseko, which is also Canada listed and which I hope to cover later on. And they have a project which is producing, and also when you listen to the CEO interview, the Excelsior people have been talking to the Taseko people about problems. So there is an exchange of expertise. And there was a mine which ran from 1986 to 1998, which successfully produced lots of copper from the San Manuel mine in Arizona. However, there is a contradiction here in that when you listen to the CEO talking about the problems they have experienced, he says it is because in situ copper mining is relatively new, that unlike uranium in situ mining, there's not much expertise in situ copper mining, and yet contained in their presentation pack is this chart showing that actually in situ copper mining has been around for quite a long time. So the question then becomes, what happened to all the expertise, and how come Excelsior have been unable to find anyone with experience of doing this and are having to basically work through all the problems themselves? And they're having problems. And these problems, frankly, are quite serious. So this is one of the submersible pumps. And you can see here that it is completely clogged up. It is covered in, is that copper sulfate? And the problems, the precipitation problems have been so severe that these filters are completely clogged and they've had to withdraw the submersible pump. And actually, this copper sulfate has coated absolutely everything. And because it's stopped circulation of fluids, these pumps have overheated and failed. Now, what is happening? Well, what's happening is that when you push the acid down the injector wells, obviously the pH is very low, and the acid reacts with the copper in the rock and dissolves it. But as it does so, the pH drops. And by the time it gets to the solution, gets to the recovery wells, the pH has dropped a lot, and there is a lot of copper sulfate in the liquid, and it's super saturated, and it is coming back out of solution around the recovery wells and blocking them and covering absolutely everything. Now, there is a solution. The solution is they've had to retrofit all the recovery wells to allow them to inject acid. So the moment this starts happening, they reverse the circulation and they inject acid into the recovery wells. The acid lowers the pH, makes it more acidic, and dissolves the precipitated copper sulfate. However, that means that there's a capital cost for retrofitting all these recovery wells with pumps to allow them to re-inject sulfuric acid. And also, you will see that it's a manual process. So all this will mean delays. Time is money. So that means you will need more pumps, more acreage to get the same amount of copper solution out, because your recovery rate per well will be lower. Now, one of the advantages of making all the wells, both injectors and recovery wells, is that you can change the configuration. Now, this is the configuration that Excelsior were showing in their presentation that we looked at earlier. So you have an injector well and then surround it for recovery wells. But changing all the wells to be both injectors and recovery means that you can play around. You can do a line drive like this, or change it like that. And all of that will hopefully, by changing the way the fluids flow through the rock, allow you to get higher recovery rates. But again, yeah, somebody will need to go round, we think, and manually change the wells from injectors to recovery.
I would imagine that if they enlarge it, Keith, they'll make that process automatic.
Yes, I would as well. This lower channel, bottom right here, where the cursor is, that is meant to be clear. But it's not. It's greeny blue, which suggests there is copper in there. Copper in solution. Why? Essentially, that is the final stage. That's the output of the copper extraction process. So not all the copper is being extracted. And it took them a while to work out that one of the polymers used in the drilling mud when they were drilling the wells was interfering with the chemical process to recover the copper. Now, they have a solution to this. They got in a specialist chemical company who supplied a reactant which will react with the polymer and remove it. So this problem is solved. A bigger problem, and this is a serious problem, is CO2 production. Now, in the rock containing the copper, there is calcite. And calcite reacts with the acid they're pumping down, and it reacts to produce carbon dioxide. And that means there is gas. As you pump acid down into the mine, you're getting a gas buildup, and that is increasing pressure. And that means as you try and inject acid in, the pressure buildup is preventing you from putting the acid in. And that means it's slowing the pumping down. And this is what calcite looks like. Now, the important thing is there's a limited amount of calcite, and it reacts first with the acid. So the acid will preferentially react with the calcite before it reacts with the copper. And so this is a problem you will initially get when you do it. You drill each well and develop each well, but over time it should go away. Now they have a solution for this, but this solution again will slow down production because it involves pumping water down into the rock to dissolve the carbon dioxide. Now, this diagram here shows exactly what the problem is. Right, the dark blue is acid being pumped in, and you'll see as you pump in the acid, the amount you can pump in just steadily declines. You're managing to pump less and less in, and that is because the carbon dioxide is building up and there's a back pressure. So then what they do is they pump in a load of water. The water dissolves the carbon dioxide, and so when they come to pump in the acid again, you get initially much higher rates of acid flow into the rock. You can see here your flow rate is 80 gallons per minute, whereas prior to the water flushing it was about 65. But then you get gas buildup again, and again your flow rate declines. So then you have to do another water flush, but then you're getting much higher rates. So
it's interesting, Keith. The water flush appears to be it's for 2 weeks, isn't it? So it's a significant period of time that they're not extracting the copper sulfate.
Precisely, Richard. That is exactly right.
They've sort of lost, so effectively during this period when the calcite is still there, their production level is effectively half from whatever the putative production level would be if there were no CO2 production.
These mines were essentially out of operation. Just think of it like that. It is no longer producing for this period.
Do we have any indications how long this problem will last?
We don't, but we do know that it will be, it should just be a function of the initial production of each well until they've dissolved, all the calcite is gone. Okay, now they have expansion plans. We're on phase 1. But a well expansion is pretty easy. You know, this is your pumps and your valves, and all you need to do is drill some more wells, plug in some more and plug them in, and then build a few more of these, and off you go. So this is an overview which we saw earlier, and that pumping system is responsible for this segment of the mine. So all you do is you drill 4 more holes, plug them in, and do the same on the other side, and there you go. You now have expanded the field. You just need to, if you've got the capex to drill more holes, buy more pumps, then off you go. Now, if you're interested in Excelsior, I really urge you to go and watch this video with the CEO. I thought he was very honest about all the problems, and actually it really filled me with confidence that they were going to get on top of them. And I really appreciated his honesty. However, That said, when you go through the quarterlies, there really wasn't very much at all about the problems they're having. And so, there is a contradiction there between the statements they're putting out in text and the CEO interview, where he's very forthcoming. But the bottom line of all these difficulties is they're going to get over them, but it will slow production down. The yield per well, at least initially, will be much lower than it was, because you're going to take time having to reverse the flow and, above all, do this water flushing. And you've seen from that earlier chart that water flushing takes a lot of time. Okay, development costs. Now, we are in phase 1. But they have plans for phase 2 to get up to £75 million a year, and that will require a capex of 146 million. Then there'll be phase 3 where they go further to 125 million, and that requires 231 million. So you're talking about another 400 million to 370 million of capex. How are they going to fund that? And in funding that, how much will shareholders be diluted? Now, if you remember back to the history, you'll see there was a lot of shareholder dilution. They sold gross revenue royalties, and also they sold a copper stream. So, all of which, gives away economics. So how much economics are going to have to be given away to develop this mine to its full potential? And they're now guiding that they want to skip straight to phase 3, given high copper prices. How are they going to do that? So this is a chart of the cash flow from them, and they're saying stage 1, based on copper of 3.25 dollars a pound, and obviously it's 4.25 and above right now, so these will be much bigger. But we will do our own calculations in a while. But you see, they're saying stage 1, $50 million a year, and then stage 2, they're chucking off serious amounts of cash, which should allow them to then fund stage 3. But they're now talking about jumping straight to phase 3, funding. Right. Now, one thing I really didn't like was I read the recent annual report, and I could find no mention of the gross revenue royalty. And you'll see that, having gone through the history, I knew they'd sold the gross revenue royalty. And it was originally signed with Callinan Royalties, who were taken over by Altius. And Altius have their own website. And so I tracked this down, and they're saying they have a 1.625% gross revenue royalty on the Gunnison mine. Why wasn't that in the annual report? What it is in the annual report is a detailed section on the copper stream. And the copper stream, basically, they've given away quite a lot. The Triple Flag Bermuda bought the rights to 16.5% of the copper produced by Gunnison at a quarter of the spot price on the market. And that falls as the mine is developed. So in stage 2, it's only 5.75%, stage 3, it's 3.5%. But they have an option to invest a further 75 million to expand their portion of the copper stream. So you see the expansion plan, if they paid 75 million, when it gets to stage 2, they'd get 11%. And stage 3, 6.6%. But Excelsior have an option to buy back half of it. And at current prices, I would fully expect Excelsior to exercise that right and buy back half it. So when we go through the economics, we are going to use this row here of 16.5% in stage 1, 5.5% in stage 2, and 3.3% in stage 3. Let's get onto that calculation. Now, I will also post the spreadsheet of this calculation onto our Discord. So if there are any mistakes, please go through it. Okay, so we start off. Phase 1, 25 million pounds a year, copper at $4. Now, bear in mind, it's about 4.4 now, and Goldman Sachs are saying it's going to go to 6. OPEX of 1.23, which is numbers that have been provided by Excelsior pre the metal stream. And we are going to work out our own calculation of the expenses of the copper stream. So that gives you gross revenue pre-reductions of 100 million a year. The copper stream is then 16.5% at a quarter of the copper price. That brings your revenue down to 87.6 million. You then have a gross revenue royalty of 1.625%, brings you down to 86, gives you an operating profit before tax of 55.5. But you then have income tax, state and federal, and that is as reported by the company in their annual report of 24.87%. So converting that all into Canadian dollars and using the fully diluted shares in issue at a PE ratio of 6, those earnings would be worth 93 cents a share Canadian, which the current share price is 80. And so on phase 1 alone, these shares are close to fair value, frankly, on a PE ratio of 6. So the bull case, in order to invest in these shares, you need to believe they can expand, and they can expand without massive shareholder dilution, because it looks much better when you get to phase 2 and 3. Phase 3, on a PE ratio of 6, then you're looking at a share price of $5.50 per share, which is almost 7 times the current share price. Now, obviously, there is funding. And if they have to give away either a metal stream or gross revenue royalty or more share, that will be diluted. But there is plenty of upside here. And if we look at the mining cycle, which we actually covered earlier in the presentation by Excelsior, you'll see they're saying they're here. They're early on, just starting development, and there is plenty of upside. So they're at the right point in the cycle. Now, this is the annual accounts, and you'll see that 2021 is going to be the first year. And we just don't know, frankly, how they're going to accelerate their expansion plans. But right now, they do have cash and a minimal of debt. So, positives. Copper price is rising. That is the reason we're looking at copper stocks. It's in a stable jurisdiction, and it's using a technology which has been used before, although they seem to be having very serious teething problems with it. And if the company can execute its expansion plans, then the shares look cheap, and it's a potential multi-bagger. It's certainly got low capex and very high IRR compared to other copper development projects. Phase 1 is fully financed, and they're just starting production. And I would urge everyone to look at the YouTube video with the CEO, Steve Twirold, and where all the production difficulties are explained. Negatives. Well, they are suffering production problems. And I frankly didn't really like the way those were not reported in the quarterlies. That, you know, if I hadn't seen this CEO interview on YouTube, I would not have properly understood them. Then, you know, you would not get that from the quarterlies or the annual reports, although the annual reports actually are more forthcoming. The bottom line with all these production difficulties is that the production per well will be slower. The individual wells will have to be taken offline for flushing with water to dissolve the CO2. Then there will also be changes as they reverse the flow, and all that takes time. So in order to get out your 25 million pounds of copper per year, as in phase one, and they're saying they want to be on target to do that by the end of this year, they will need more wells, which means more capex. And are the teething problems over? You know, the share price, the copper price is shooting up. The share price of Excelsior, it ain't. So the market is currently concerned that the teething problems are not over. But above all, how much dilution to shareholders is there going to be as they expand? Richard, your thoughts?
Yeah, thank you very much, Keith. Very, very interesting talk. Could you go back to the positives slide, please? Yeah, so I think a very interesting talk, Keith. Thank you for that. Very well researched. It's obviously they are evolving a new technology for copper mining in this particular substrate with the deposits of calcite. And I guess it's not surprising they've had teething problems. We don't know how long it will take for the carbon dioxide issue to disappear, but as you rightly point out, presumably at some point it will. So that means there's a lag in production ramp up as opposed to failing to achieve anticipated production. Clearly the back flushing does slow it down. I don't know how much it costs to sink one of these wells and to connect it up to the flows. It's difficult to determine exactly what the additional capex would be in order to overcome the production flow rate problems that they're having. And that's probably variable in any event. And I say not only is the copper price rising, but it appears to be sustainable rise. And there's a report by the International Energy Agency that is in the news now, which is talking about the massive need for metals used in green technologies, which obviously includes copper. So I suspect the copper price is going to continue rising. Personally, I suspect it's going to continue rising for quite a long time, and I suspect it will not fall back to where it has been. I like the simplicity of the mining technique. They don't have to move vast quantities of material. They don't have huge spoil heaps. They don't have all the geological and mechanical problems of digging tunnels. I think it's a very elegant way of mining, and which of course is why it has a low capex to recovery per pound, which is a very interesting way of searching. And could you just pop to the negatives, Keith, please? So I think they could be forgiven production problems, given that they are introducing a new method of production. I think that one would hope the teething problems are out of the way, but we won't know until they've had a run of production, probably a number of months, in order to determine that everything is settled down and operating as expected, and that something doesn't arise as a consequence of the erosion of the deposit by the acid. We won't know that for a while. As you say, it's a shame that they don't report the production problems in their quarterlies, which does leave a little bit of a question mark, but it's nice that the chief executive gave such a fulsome interview. And if the copper price continues to go up, it strikes me that they may be able to fund some more of their expansion than they originally anticipated out of cash flow, which would reduce the shareholder dilution required to get to phase 3. I think it's a very interesting proposition.
No, I bought some, but because I like this, and however, there are problems here, and we've discussed this, and some of the things you have just highlighted, Richard. But the CEO in the interviews is saying this is new, and then he produces charts showing that actually it's been done in Arizona for years. So that's a contradiction which I really haven't got to the bottom of.
No, I don't know. Is the chemical composition of the substrate that the copper is in? Is it the same in the other mine in Arizona? Do they have the CO2 problem, for example?
Well, we don't know about the CO2 problem, but the precipitation problem, which caused them the initial difficulties, that would be the same anywhere.
Yeah, well,
and they clearly would.
But also, it might depend on the concentration of copper in the substrate mine. I don't know, but if it does, and there's a different concentration, precipitation may be different. I think it's hard to draw a direct comparison without knowing, the precise chemistry of the ore body.
Well, the thing is, Richard, it depends actually on the pH of the liquid as it moves across, and you would expect that to be the same in any rock. But anyway, that's that aside. I think that currently the market is not giving them any credit for being able to get phase 2 and phase 3 done, given where the price is.
They're assuming that it sticks at phase 1, aren't they? And that's all that happens.
Yeah.
Which is unlikely, I would say. Unlikely.
Absolutely. Now, one thing, as we went through this, other thing I'd say is, you look at the cash flow chart that they were showing, that seemed to show cash flow of about 50 million a year at copper at 3.25. Now, in our calculation, we've used 4, and we've got less than that in US dollars. So that is a question.
Yes.
But I think there's plenty of upside here. I think actually having seen the CEO interview, where he was very honest, I think they'll get on top of this, but it will require more capex and more wells to hit target. So, when they're saying they're on target for 25 million pounds of copper per annum by the end of 2021, in order to hit that, they're going to need to drill more wells than they would have done pre-problems. Yeah. And I have not seen anywhere them quantify how many more wells they're going to need.
And indeed, how they'll fund it.
Precisely.
Yeah.
But now they have cash. Then now they should be getting a lot of cash flow, actually, given these high copper prices. So hopefully you'd say they'll be able to self-fund. Anyway, I hope you all enjoyed that, and we will on the lookout for other copper assets, and hopefully in the coming months we will be covering a few. As I mentioned, I have bought these shares, so please be aware of that. And in the meantime, please can you subscribe and press like, and it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.